Welcome to the deep dive. If you're tuning in today, you're likely what we call the learner.
Yeah, maybe you're prepping for a crucial Monday morning meeting.
Right, or trying to catch up on what has been an incredibly chaotic week in the markets.
Or you're just insanely curious about how the global economy actually wires together.
Exactly. Whatever brought you here, we're thrilled to have you. Our mission today is straightforward. We are taking a substantial stack of sources.
And it is a massive stack this week.
It really is. We've got intense geopolitical analyses, the CSFX commodity and crypto market reports, weekly summaries from Charles Schwab and LPL Financial, and a comprehensive timeline of the unfolding 2026 Strait of Hormuz crisis.
We're basically extracting the absolute most critical insights from all of that.
Right, giving you the shortcut to being comprehensively well-informed without drowning in the data. But before we jump in, our sources contain politically charged content regarding the ongoing conflict between the U.S., Israel, and Iran. We are not taking any sides or endorsing any viewpoints. We are impartially reporting the facts and market reactions exactly as they are laid out in the source material.
Spot on. We're just looking at the data.
Right. So with that said, we are breaking today's deep dive into 4 distinct parts, blending a few together for maximum impact. Part 1 is the timeline and market summary of the last week.
Then we'll seamlessly combine parts 2 and 4 to cover idiosyncratic stock movers and those significant financial results.
And finally, part 3 will cover the wild swings in commodities, bonds, and crypto.
It's a lot of ground to cover, but the way these different asset classes are reacting to the exact same global events right now is, it's truly a masterclass in how modern capital markets function under extreme stress. Every sector is telling a slightly different version of the same story.
Okay, let's unpack this, starting with part 1, the timeline of the last week. The dominoes really started falling over the weekend of February 28 to March 1st, 2026.
Right, the onset of Operation Epic Fury.
Yes, the coordinated U.S. and Israeli airstrikes on Iranian military and nuclear facilities. And almost immediately, the Islamic Revolutionary Guard Corps, the IRGC, retaliated by announcing the closure of the Strait of Hormuz to all commercial traffic.
And this wasn't an empty threat.
No, not at all. By Sunday, the oil tanker Skylight was hit by a projectile north of Oman, resulting in casualties. And another ship, the MKD DYOR, was targeted by a drone boat that sparked an engine room fire.
And we really need to pause here to understand why this specific waterway matters so much to your portfolio, regardless of what you're invested in. Roughly 20% of the world's daily oil supply and a significant portion of its liquefied natural gas normally transits through the Strait of Hormuz.
It's massive.
It is the ultimate global energy choke point. To put it in perspective, if global trade is a cardiovascular system, the Strait of Hormuz is the carotid artery. So when the U.S. markets opened on Monday, March 2, the expectation across trading desks was absolute panic.
Sure.
But instead, we saw what analysts are calling a resilience mirage. The S&P 500 actually closed that Monday with a tiny gain of less than 0.1%.
Wait, I have to stop you there. The S&P closed with a gain on the exact same day the world's primary oil artery was choked off.
Yeah.
That doesn't just sound like a resilience mirage. That sounds completely irrational. How much of that was just algorithmic trading taking over?
A profound amount. Under the hood, it wasn't a rally, it was a violent rotation. Energy and defense stocks surged, naturally, given the conflict. Algorithms automatically buy defense contractors when missiles fly.
Right. The algorithms don't feel fear, they just execute the code.
Exactly. But that targeted buying perfectly offset steep plunges in the travel and leisure sectors. Cruise lines and airlines were getting hammered as human investors rapidly priced in severe fuel bill increases.
And the immediate logistical nightmare of disrupted Middle Eastern flight paths and cruise itineraries.
Precisely. The index looked flat, but the individual components were experiencing violent whiplash.
Which brings us to Tuesday and Wednesday, March 3 and 4. The IRGC formally claimed complete control over the strait. We saw an explosion on the tanker Sonangol Namibe near Kuwait, which caused a substantial oil spill and proved this wasn't just confined to Iranian waters.
Right, the conflict footprint was expanding.
Yeah. But while all eyes were on the Persian Gulf, some fascinating cracks started showing up in the domestic financial system, specifically in private credit.
This is where it gets scary.
Yeah. We saw both Blackstone and BlackRock stepping in to limit redemptions on their sprawling private credit funds. BlackRock, for example, had $1.2 billion in redemption requests, but only paid out $620 million. For the listener who might not trade institutional debt, why is gating redemptions such a glaring panic signal?
What's fascinating here is that we aren't just looking at a geopolitical shock. We're looking at a geopolitical shock converging with macroeconomic fragility.
Okay.
Private credit has been the primary engine for mid-market U.S. companies over the last decade. These funds loan money to private businesses. The catch is, those loans are highly illiquid.
I can't just sell them on a whim.
Right, you can't just sell a loan made to a regional plumbing supply company on a Friday afternoon.
Yeah.
So when investors get spooked by a potential regional war and ask for their cash back, the fund literally cannot liquidate assets fast enough.
Wow.
Gating redemptions is the financial equivalent of smelling smoke in a crowded theater and locking the exits to prevent a stampede.
That is a terrifying visual, but it makes perfect sense. So investors are realizing their money is locked up just as the world gets highly unstable.
Exactly. This underlying anxiety is what led to the technical breakdown we saw on Thursday, where the S&P 500 finally dropped below its 100-day moving average.
A major technical level.
Yeah. For algorithmic trading models, the 100-day moving average acts as a psychological and mathematical floor. When an index falls below it, the algorithms shift from buy the dip to sell the rally. It was the market's armor finally cracking, leading us right into Friday's brutal reality check.
Friday, March 6th. The absolute shocker. The U.S. Bureau of Labor Statistics released the February jobs report. The consensus expectation was a gain of 60,000 jobs. Instead, the U.S. lost 92,000 jobs.
A massive miss.
The largest monthly drop we've seen since the pandemic. Unemployment ticked up to 4.4%. But here's the kicker. Despite the heavy job losses, average hourly wages actually rose by 0.4%.
If we connect this to the bigger picture, this is the textbook definition of a perfect storm for stagflation. Stagflation is the absolute worst-case scenario for central banks.
Because it's a double-edged sword.
Exactly. You have a contracting labor market, people actively losing their livelihoods, colliding directly with rising prices. Energy costs are surging because of the conflict, and yet wages are still climbing, which keeps core inflation sticky.
It sounds like the Federal Reserve is trying to put out a fire, but their only two options are throwing a bucket of ice water that completely freezes the labor market, or throwing a bucket of $90 oil that burns the entire house down with inflation.
That is precisely the dilemma. Do they cut interest rates to save the jobs market, knowing it could pour gasoline on the inflationary fire? Or do they hold rates high to fight the inflation and risk pushing the underlying economy into a deep, painful recession? They are completely trapped.
It is a terrifying tightrope for the Fed to walk. And hey, speaking of navigating chaos, if you are finding this breakdown helpful to understand how all these incredibly complex moving parts actually affect your money, please take a second to subscribe, like, or comment on our YouTube channel. It tells the algorithms that this is valuable, and it helps us know exactly what kind of deep dives you want us to do next.
It really does help us out and allows us to keep bringing you these insights.
Absolutely. All right, let's pivot to parts 2 and 4. So the Fed is trapped, the global oil choke point is shut down, and the labor market is cracking. You would think the entire stock market would be a sea of red.
You really would.
But this brings us to the idiosyncratic stock movers and financial results. Because the tech sector is essentially ignoring the war. Here's where it gets really interesting. Let's look at the winners. Marvell Technology popped an extraordinary 22.1%.
Yeah, Marvell's financial results were exceptional and incredibly revealing about where institutional money is hiding. They hit a record $8.195 billion in revenue.
That's huge.
It is, but the crucial detail here is their custom silicon division. That specific revenue stream grew from essentially zero to $1.5 billion in a single fiscal year.
For the listener, what exactly is custom silicon and why is it shielding them from this macro dread?
So general-purpose chips are great, but AI data centers require highly specialized, custom-designed semiconductors to handle specific workloads efficiently without melting down or drawing too much power. Marvell designs those custom chips. This earnings report proves that the AI hardware build-out theme is still acting as an impenetrable firewall against broader macroeconomic fears. Companies are still pouring billions into AI infrastructure, completely regardless of what Brent Crude is doing. We saw similar strength projected by Broadcom, too.
It is genuinely like there are two completely different economies operating in parallel right now.
Yeah.
Speaking of tech thriving in a difficult environment, Samsara jumped 17.38% after a really strong earnings report. They build fleet management software.
Right.
At first glance, software for delivery trucks doesn't sound as sexy as AI chips, so what drove that spike?
Think about how perfectly Samsara connects to the macro environment we just discussed. What are physical businesses terrified of right now? skyrocketing fuel costs and a tightening, expensive labor market.
The exact stagflation fears we talked about.
Exactly. Samsara provides the exact software needed to optimize physical operations. If you operate 10,000 trucks and Samsara's software can optimize your routing to save just 3% on fuel, that is a staggering amount of capital saved when oil nears $90 a barrel.
That makes total sense.
Institutional investors recognize that in an inflationary environment, efficiency tools transition from nice to have to absolutely mandatory. That realization pushed Samsara's market cap to an impressive $20.4 billion.
Fascinating. But the absolute biggest idiosyncratic mover of the week wasn't in tech at all. It was day one biopharmaceuticals, up an incredible 65.6%.
A massive jump.
The catalyst was a $2.5 billion all-cash buyout by the French pharmaceutical group Servier. They bought them out at $21.50 a share, specifically to acquire their glioma drug, Ojemda.
Which highlights another proven market firewall, high-value biotech M&A. When a company has an approved, highly specialized therapeutic drug, its value is almost entirely divorced from the price of oil or the Fed's interest rate path.
Right, because health doesn't care about the Fed.
Exactly. A life-saving therapeutic is a necessity, not discretionary spending. It remains heavily insulated from geopolitical shocks.
On the flip side, there were some brutal losers. Ingram Micro dropped 17.4% after pricing a secondary offering right on the heels of their earnings report. Then there's Rumble, which hit a 52-week low, down 13.6%.
Their numbers were rough.
Yeah, their Q4 earnings showed a 10.5% revenue decline, despite their monthly active users actually going up. And finally, Gap plunged 8%, primarily blaming weather-related store closures in January for hurting their Q4 earnings. If we synthesize these three drops, Ingram, Rumble, and Gap, it feels like they're telling us a cohesive story about capital allocation.
They absolutely are. What Ingram Micro, Rumble, and Gap tell us is that the market's forgiveness is entirely gone. In a stagflation environment with high interest rates, investors have zero patience.
No room for error.
None. Growing a user base is great, but if you can't translate those eyeballs into actual growing revenue like Rumble failed to do, you get punished instantly. If your business model is highly vulnerable to physical, real-world disruptions like Gap's traditional retail footprint, capital flees. Right now, capital is exclusively hiding in efficiency, specialized therapeutics, and AI infrastructure.
That is a brilliant way to frame it. Let's pivot to part 3, commodities, bonds, and crypto, where that flight of capital is highly visible. We have to start with oil, the main character of the week.
Yeah.
Brent Crude spiked over 13%, nearing $93 a barrel.
Yeah.
Goldman Sachs released a note estimating there's a $14 risk premium currently baked into that price just based on the fear of escalation.
And it isn't just oil. You have to look at the natural gas context to understand the full geopolitical strategy. Qatar announced it was suspending its LNG liquefied natural gas production. With the Strait of Hormuz closed, Dutch TTF natural gas prices, which are the European benchmark, are projected to approach 74 euros per megawatt hour if this blockade persists.
That's a huge surge.
It is. What we are witnessing is Iran employing a strategy of maximum chaos. By choking off both oil and LNG simultaneously, they are applying intense structural inflationary pressure directly onto Western economies, trying to force a diplomatic resolution through sheer economic pain.
It's a high-stakes pressure campaign, hitting voters right at the gas pump and the thermostat. And naturally, when inflation fears spike, people look to precious metals. Gold is holding around $5,113 an ounce.
Still strong.
Yeah, that's down from its all-time high of 5,595% back in January 2026, but it is holding strong. However, silver is the real story here, jumping 6.5% to $93.29.
This raises an important question. Why is silver outperforming gold so noticeably right now? If we synthesize our sources, silver benefits from a unique dual demand structure.
Okay, dual demand.
Yes. It acts as a monetary safe haven during times of war and inflation, just like gold. Investors buy it to protect purchasing power. But silver is also a critical industrial component. It is highly conductive and essential for solar panels and electric vehicles. Right now, the market is facing a severe 1 million metric ton structural supply deficit for silver.
So you have the entire world legislating a green energy transition, requiring millions of solar panels, colliding directly with a genuine physical shortage of the metal required to build them. And then you add war panic buying on top of it.
Exactly. It is a potent combination of industrial necessity and monetary fear.
Moving over to the bond market, things are acting a bit counterintuitively.
Yeah.
Usually when a major war breaks out, we see a flight to safety.
Well,
Investors flood into U.S. government bonds, which drives the price up and the yields down. But this week, the 10-year Treasury yield actually rose to 4.14 or 4.15%, and the 2-year yield sits at 3.56%. Why isn't there a flight to safety?
because right now the fear of $90 plus oil is completely overriding the geopolitical panic.
Oh, interesting.
Investors know that expensive oil means sticky, persistent inflation across the entire supply chain. And inflation is the absolute enemy of a bond. If you lock in a fixed return for 10 years, but inflation runs hotter than your yield, you are actively losing purchasing power.
Right.
So investors are demanding higher yields to compensate for that severe inflation risk. It is also worth noting the yield curve remains inverted.
We hear about the inverted yield curve all the time in financial media. For the listener trying to decipher the jargon, what does that actually mean for the broader economy?
Under normal circumstances, you expect a higher interest rate if you lock your money up for 10 years versus 2 years because there is more unknown risk over a decade. An inverted yield curve happens when the 2-year yield pays more than the 10-year yield.
Meaning?
It means investors believe the short-term future is actually riskier and more volatile than the long-term future. Historically, it is one of the most reliable warning signs of a looming significant recession.
Which brings us to the ultimate risk asset, crypto. The overall market sentiment is officially at extreme fear, sitting at a 14 on the sentiment index. Bitcoin took a heavy hit, down about 44% from its 2025 peak of $126,000, currently trading around $70,756. Ethereum is also struggling, stuck below that key $2,000 psychological level.
But not everything is red.
Right. Amidst all that red, Solana is showing profound resilience, trading around $87.69. Why is Solana bucking the trend?
Solana's relative strength is a fascinating blend of technical upgrades and fundamental adoption. It actually led the recovery surge over the weekend. Technically, they are rolling out their Alpenglow upgrade, which pushes transaction finality down to a blistering 150 milliseconds.
Let's break that down. What does finality mean, and why do traders care about 150 milliseconds?
Finality is the moment a transaction becomes irreversible on the blockchain. In traditional finance, if you swipe a credit card, the settlement can take days. Even on older blockchains, it can take minutes. Pushing that down to 150 milliseconds means trades settle almost instantly.
That's incredibly fast.
That specific speed is highly attractive to high-frequency algorithmic trading firms who need to move capital at lightning speed to capture arbitrage opportunities.
So it's built for Wall Street speed.
Precisely. And more importantly, Solana is getting major institutional validation. Traditional finance giants TradFi like BlackRock and Franklin Templeton are actively issuing tokenized real-world assets directly on the Solana blockchain.
Basically putting real assets on-chain.
Yeah. Tokenizing an asset means taking something like a treasury bond or a piece of real estate and representing its ownership digitally on the chain. Because institutions are building actual financial infrastructure on Solana, it provides a floor of utility and demand, even when retail sentiment is frozen in extreme fear.
So what does this all mean for you, the listener?
Okay.
If you step back and look at the entire board we just covered, the market right now is caught in a violent tug-of-war. On one side, you have the undeniable record-breaking revenue of the AI revolution.
Companies like Marvell proving the tech boom is real.
Inefficiency software like Samsara becoming mandatory. On the other side, you have the sudden, very real risk of 1970s-style stagflation, driven by closed shipping lanes, surging oil prices, and a shocking contraction in the U.S. labor market.
I want to leave you with a final thought to mull over, connecting those two exact forces. We see hardware companies like Marvell booming as corporations spend billions to integrate AI into their workflows. But we're simultaneously seeing reports warning of severe AI-driven labor displacement.
The human cost.
Exactly. What happens to the broader economy if corporations successfully use AI to drastically cut human jobs and payrolls right at the exact moment that $90 oil and soaring utility prices severely squeeze the average consumer's wallet? Will the corporate rush for AI efficiency inadvertently deepen the very stagflation trap the Federal Reserve is desperately trying to avoid?
That is a heavy, critical question to keep an eye on in the weeks ahead, especially as we see how consumer spending holds up. Remember, investing always carries risks, especially in a macroeconomic situation as highly volatile as this one. You must always do your own research or consult a professional before making any financial decisions. Thank you so much for joining us on this deep dive.